Same title, same salary, down to the dollar. Same job for the same 3 years. But at the end of this year, Kai owes about $3,400 less in tax than Zara does. Neither of them cheated. Neither of them found a secret loophole. Kai just made a handful of different decisions about the same paycheck, and those decisions are legal, public, and available to almost anyone. Quick note before we go further. This video uses the US tax system because tax rules differ enormously between countries, and mixing them together would make this useless to almost everyone. Most people think of taxes like a toll booth. Money comes in, a percentage gets taken, and whatever's left is what you have. Under that belief, the only way to keep more is to earn more, since the tax itself feels fixed. That belief causes a specific, expensive mistake. A lot of people quietly believe a raise can backfire, that crossing into a higher tax bracket means your whole income suddenly gets taxed at that higher rate. So they hesitate to negotiate. They turn down extra hours. They worry a promotion will push them into a bracket and cost them money. It won't. Tax brackets work like a staircase, not a cliff. Each dollar you earn is taxed based on which step it's standing on. Your first stretch of income is taxed at the lowest rate. The next stretch, a bit higher. Only the new dollars from a raise ever touch the higher rate. Every dollar below stays exactly where it was. A raise never shrinks your paycheck. That clears up the myth. But it doesn't explain Zara and Kai. They're on the identical staircase. Same steps, same income. So the $3,400 has to come from somewhere else. Here's where it actually comes from. Not all income is taxed the same way, even at the exact same dollar amount. What matters isn't only how much you earn, it's what you do with it before it becomes fully taxed income. Zara's paycheck takes the simplest possible path. It lands in her account, gets taxed as ordinary income, and whatever remains is hers to spend or save. Kai takes the same $100,000 salary and makes 3 different choices with pieces of it. First, Kai contributes to a workplace retirement account. Contributions like this can reduce the income that's counted as taxable this year. The tax isn't erased, it's deferred, ideally to a later year when the money is withdrawn, possibly at a different rate. On $8,000 contributed, that's roughly $1,760 in tax deferred this year alone, depending on Kai's bracket. Second, Kai qualifies for a health savings account, which only certain health plans make you eligible for. Money that goes in isn't taxed, it grows without being taxed, and it comes out tax-free when used for medical expenses. On a $3,000 contribution, that's another few $100s kept out of this year's tax bill. Third, when Kai sells investments, timing matters. Assets held over a year are generally taxed at the long-term capital gains rate, which for many income levels is noticeably lower than the rate on ordinary wages. Zara, by contrast, trades frequently and pays her gains at her regular income tax rate. Add those 3 differences up on identical $100,000 salaries, and you land somewhere close to that $3,400 gap. Not a trick, not a discount for being clever. 3 legal decisions about where money sits before it's taxed, and this is where it gets bigger than 1 year. $3,400 sitting in a taxable checking account is just $3,400. But $3,400 that stays inside a retirement account, growing every year instead of being handed over, behaves differently. Over 10 years of consistently making these same choices, that gap compounds into tens of thousands of dollars. Over 25 years, it can be the difference between retiring comfortably and retiring anxious. The real advantage was never the $3,400 saved this year. It's what that $3,400 left alone to grow eventually becomes. Now, an important distinction, because this can start to sound like a shortcut. Legal tax planning and illegal tax evasion are not close cousins. Tax planning means using rules the tax code already lays out on purpose. Contribute here, get this treatment. Hold this long enough, get that rate. Tax evasion means hiding income or lying about expenses. Kai isn't doing anything the IRS doesn't already expect and, frankly, want people to do. Retirement accounts exist because the government wants people saving for retirement. Long-term capital gains rates exist because the government wants people investing patiently instead of trading constantly. Every door Kai walks through is one the system left open on purpose. Now, an important distinction, because this can start to sound like a shortcut. Legal tax planning and illegal tax evasion are not close cousins. Tax planning means using rules the tax code already lays out on purpose. Contribute here, get this treatment. Hold this long enough, get that rate. Tax evasion means hiding income or lying about expenses. Kai isn't doing anything the IRS doesn't already expect and, frankly, want people to do. Retirement accounts exist because the government wants people saving for retirement. Long-term capital gains rates exist because the government wants people investing patiently instead of trading constantly. Every door Kai walks through is one the system left open on purpose. It's also worth separating two things. People mix up constantly. A deduction lowers the income you're taxed on, while a credit lowers the tax bill itself, dollar for dollar. They're not interchangeable, and knowing which one you're looking at changes how valuable it actually is. So what do you actually check for yourself before the year ends? Start with your employer retirement plan. See what's offered and whether you're contributing enough to get any employer match, since that's money left on the table otherwise. Then check whether your health plan qualifies you for an HSA, since it's one of the few accounts with tax-free treatment going in, growing, and coming out. Then, look at your investments and notice whether gains are being taxed as ordinary income or as long-term capital gains, because holding periods matter. Then, look at deductions and credits you're actually eligible for, rather than assuming they don't apply to you. And finally, do this review before December, not in April. Most of these decisions only work if you make them while the year is still open. None of this requires hiding money. It requires knowing which doors exist before your money walks past all of them and into the most heavily taxed one by default. So, go back to Zara and Kai. Same job, same salary, same staircase. The $3,400 gap wasn't about who earned more. It was about who let every dollar walk straight through the front door, and who took 30 minutes to learn where the other doors were. Two people can earn identical incomes and end up in very different financial positions, not because of talent or luck, but because of what they allowed to be taxed and when. That's the whole game.